So basically, the strategy is comprised of three things. The first thing we put into consideration is our market structure. We talk about our time frame, confluence, combination or confluence, whichever one, because it really matters alone. Then we'll talk about our order block. And after our order block, then we'll talk about our TPI, which we use for final confirmation to enter our trade. So basically, this is the three things, the four things we'll be talking about, and this is what the four things the strategy comprises of, right? That's what the four things that the strategy comprises of. So the most important of all is the market structure. The most important of the market structure, and basically when we talk about the market structure, is the fundamental in trading. Once you don't get it right from market structure, you can't get it right. That is simple fact. So basically, we have three ways. There is three market conditions in the financial market, whether currency pairs, synthetic indices, or any other thing we could think of that is being traded in the financial market. So basically, is it that we So basically, is that we have an uptrend, the market going uptrend, or we have the downtrend, and the final one we have the sideways, what we will call it consolidation. So for the market structure, right, the strategy actually works on two, or we advise trade to, which is the uptrend or the downtrend. Actually, when we talk about the uptrend, basically we talk about market making a series of higher high like this, right? So basically, we take this to be our higher high, and then we take this to be our lower low. So we take this to be our higher high. We take this one to be our low, or we can call it higher low, whichever one you want to call it. Right? We take this to be our higher low, and we take this to be our higher high. Right? We take this one to be our higher high. Take this to be our higher high. As that journey, put your mind so that you know disturb. So when we talk about this, right? When we talk about this market structure, basically, and sometimes we call this one to be our what? Sometimes we call this one to be our what? Call this to be our expansion. Let me just put it as E, right? And then we'll call this to be our retracement. These are fundamental things that you need to know. Many people have really find trading very difficult because the basic that you need to know, you did not know about it. Right. So basically now, by the time we now take what, this is our market structure for an uptrend. This is our market structure for an uptrend. So this expansion now, by the time we bring it out, we divide it into three perspectives. Normally, we only divide it into three. We divide it into three, right? This expansion like this. So we take the range of this, right? So we have the middle part of it, and then we have the upper part of it, right? So for an uptrend, it varies, right? So at this top here now, this is our higher high. Mostly we label it to be our premium, right? We label it to be our premium. We label it to be our premium, right? We label this one to be our premium. Please unmute your mic. So basically, we take the upper part to be our premium, right? And then the lower part to be our what? The lower part to be our take the lower part to be our discount price, right? We'll take it to be our discount, right? And then we'll take the middle part to be our equilibrium. So for an uptrend now, this is how we categorize its equilibrium. Right? So in ideal situation, if the market is actually trending, right? So what you do is that once the first thing you need to do is that once you get out, you look at the market, you mark out these things, right? The premium, the equilibrium, and the discount, right? So in ideal situation, you should look to buy at discounts, right? You should look to buy at discount, and then you sell at premium. Then in some situation, the market might not actually retrace down to the discount level, but at least before you could think of buying, the market should retrace to the equilibrium, right? Market should decrease the growth. So what you do is that by the time you open your chart that you want to trade, the first thing you need to do is that go to your higher time frame, right? Go to your higher time frame. In ideal situation, this is what we are going to have. No, we have it like have our higher high, higher low, right? So in an uptrend, so what you do is that you just go to your higher time frame, right? You take out the last swing or the last expansion, which is always going to be this, right? So you mark it out, you mark out the range. The range is very, very important when you are doing your market structure. You mark out the range, right? Let me change the color for the range. So you mark this out, right? To be your what? To be your range, right? And then you mark this out. You mark the highest part, highest point and the lowest point, right? You mark it out. My line is breaking. Is it available to everybody, or it's just you that have my line is breaking up? So basically you mark out the word the I. So this is going to be our what? Our premium, right? And this is going to be our what? Our discount level. Sefiu Mohammed, Sefiu Lakabir, I guess it's your network. Everybody could say it's okay. So you mark out the what? The range, this expansion, right? Or let me just start from here. Let me just put this into consideration now so that we'll know. So you assume now you come to the market at this point here. This is where you came into the market, right? So the first thing you do is that this should always be done on a higher time frame, right? Depending on the kind of trader that you are, right? Depending on the kind of trader that you are. So let's assume the market is there currently when you enter the market or you open your chart. Before you could think of buying, you need to wait for what? Wait for this retracement here. At least, and then remember I told you this is going to be our premium. You don't ever make mistake of buying at premium. No.
Hmm? No, to back me change.
Please
No,
unmute your
ni
mic.
change. Ah, man, no will. What is the rap change? That's me change.
So basically, you do what? Let's assume you came to the market at this point here. This is the mistake majority of us make. By the time you see the market going on, wow, I've missed the setup. Let me you just what? You just enter the market at this very point. It's very, very bad. Very, very. If you enter the market like this, market will keep going, and then you say, oh, it's wrong, it's wrong, it's wrong. Market keep reversing. Market keep reversing. So let's assume you open your chart and the market is there. Remember, just mark out this range here. Mark out this range, right? So you mark out this range to be your what? You mark out this range. So this is going to be your what? This is your higher high, right? And then you mark out your range here to be your what? To be your, you mark out your range here. You mark out your range here, right? So this is going to be what? So in ideal situation, this is going to be your higher high, right? This is going to be your higher high. right? On what? On higher time frame, that whichever higher time frame you want to work with. By the time I get to time frame combination, I'm going to talk more about like higher time frame. But mostly you should always look for your what? For your market direction on your 4 hours time frame or your daily time frame, right? But virtually it depends on the kind of trader that you are. But as part of majority of all new traders, we always fall at the what? At the intraday level of traders. So mostly you go to your higher time frame, which is going to be your 4 hours or your daily time frame, and then you mark out the last swing the market has made, whether it's an uptrend or a downtrend. The same things are applicable to what? To a downtrend or an uptrend. So this is going to be your what? This is going to be your higher low, right? So in this situation, you see this expansion here. Let's assume this is our 4 hours time frame, right? This is our 4 hours time frame on our H4, right? So let's assume this is our 4 hours time frame. So this expansion here, remember we call this one expansion that you see as what? As a straight expansion to the right hand side. By the time you go to your lower time frame, this is what you are going to be seeing there, right? This is what you are going to be seeing on your lower time frame. Your higher high, higher low, higher high, higher low, higher high, higher low. This is what you see on your what? On your lower time frame, right? This is what you are going to see on your lower time frame. So by the time you open your 1 hour time frame, you see this expansion, mark out the range here. If this is going to be what? If this is going to continue to be an uptrend, we expect them to what? To take out this high, right? We expect the market to just come down like this and come down like this, and then we'll take out. But the moment they break this swing low here, this lower part of it, we are in a downtrend. There's what we call breaking market structure. So is it that if it's going to be an uptrend, they have to what? They have to break the market in the upside. If you look at it from here, wherever we start our uptrend, we have this higher high, right? Higher low, higher high. There was a what? There was a break in market structure here. There was a break in market structure, and this one, they take out this. What just my break in market structure? The ability of them to take out the liquidity here, right? They break the structure here, and then they expand to the up. So they break a retracement back, and they still break this structure here. There's a PMS here, right? So if this is going to continue as an uptrend, then that means they have to take out this high here, right? But the moment they take out this low here, that means there's a change in market structure. So that means you should look for what? For a sell setup. I don't know if you are following me.
You are making sense, sir.
Okay. So if this is going to be an uptrend, they should break out. If this is going to be an uptrend, right, that means they should take out this what? This high here. But when they take out this low here, that means there's a change in market structure, right? That means you are looking for a sell setup. It doesn't mean that, okay, you don't have to wait. So this expansion now, you take the range of it out. You take the range. You take the range of it high, right? You take this range, right? And this is what I'm telling you now. So this range here now, basically you divide into 3, right? So you just take out your rectangle or your Fibonacci or any other means you want to measure the range here. But mostly I use Fibonacci. So you mark it out from your what? From your high, from your swing high, your higher low to your higher high, right? This is going to be the middle range of it, right? So this is going to be your equilibrium, right? This is going to be your equilibrium. And this higher high is going to be your premium price. This is going to be your this higher high is going to be your premium price. While this higher low is going to be your discount price. So in this situation, even in the real market, you don't expect to buy when the price is high. You rather wait for the price to be low before you buy. You buy at a low price and you sell at at a high price, right? So this higher high is going to be our what? It's going to be our premium, right? It's going to be our premium. Permit me to just abbreviate it as P, right? And the middle range of it now. The middle range of it now. Let's take it. This is going to be our middle range, right? So this is going to be our equilibrium. Permit me to just abbreviate it with E so that I will not waste time. So this is going to be our equilibrium. And this higher low now is going to be our discount. So in this situation, The mistake many of us make is that by the time you see this expansion, like, wow, you missed a pure trend. You just enter the market, bam. And when you are entering the market, you do not take note of these things, this premium, discount, and equilibrium. The market is already at a very high price. It is not advisable. It is not of good advice. You buy when the market is high. Don't worry, I will still go into the chart so you see it directly. But let me explain very well before we move to the chart. By the time I get to the chart, you understand more better. So this is going to be the what? The equilibrium price. So in this situation, you should wait for price to what? To reverse from this higher high at least to your what? To your equilibrium before you can think of buying. In some instances, they can pass your equilibrium, right? Some instances they can, but at least they must what? They must reverse to what? To your equilibrium price. At least they must what? There must be a retracement back to your equilibrium before you can think of buying. Before you can think of buying, right? So at least they must make a retracement to this point here. At least they must make a retracement to this equilibrium price. Sometimes they might tend to expand directly. They might go beyond it, but at least before you can think of buying, price must have replaced 50% of the time of this former range that we have. Then from there now you can now look out to buy. So at this point here, this equilibrium, by the time you look at it very well, you might find your other block. Most times you find the other block here. Your other block or your breaker, you find it at this equilibrium. Anyway, from this equilibrium to discount is a very good place to buy based on your setup, right? But don't make the mistake of buying at this stage. So it seems that it's capable to what? To a downtrend. And then when it comes to breaking market structure, taking out this high now, we label this area to be our what? We label this area, this high now, when they take it out, we'll call it BMS. BMS, right? We'll call it BMS, and then when you take out this I too, we'll call it BMS, right? So for this BMS now, there are two types of BMS. Take note of it. There are two types of BMS, and then mostly for any BMS, there must be a candle close. Every BMS must be confirmed with a candle close. So this now, right? Let's assume it's your normal bearish candle. Let's assume your normal bearish candle. You have your wick like this, right? You have your wick like this. This can be a what? Can be a wick and can be a full candle, but there must be a candle that will close above this previous swing here. There must be, whether it is a BMS at the premium or at the discount. If it's here too, if the market is coming to break this low now, there must be a candle that will close above the former range. If there is no candle that closes above the former range, it is just a liquidity grab. Don't make mistake. That means this range is still valid. So for us to take out this line, there must be a what? There must be a candle that will close above this high, right? Above this high. That means by the time we see a candle that closes above this high, that means the breaking market structure is confirmed, right? So let me just move to chart and then we'll show a practical example of it on chart. Then you understand more better. But any question so far?
I have questions, sir.
What's the question, sir?
Yeah. The candle you said, the candle that we will consider, which will close at the premium level, must it be on the time frame, on the particular time frame, like this 4 hours time frame? That means
mostly it should be on your higher time frame, right?
Okay,
it should be on
it
your
should
higher
start
time frame that you use to determine your trend. It should be on your higher time frame. But sometimes by the time you go to, this is where your your time frame combination comes in place now. On 1 hour time frame, it can be a candle close. But by the time you get to your 4 hours time frame, it's just going to be a week. So this is where your ability, your knowledge of time frame combination now comes in place. You understand? But mostly on the time frame you are putting into consideration as a higher time frame, it has to be a candle close for your breaking market structure.
Okay.
Mr.
Okay.
John, you are raising your hand. What's the question? Any problem?
Yeah, my question is it advisable to trade during retracement, I mean?
Well, you can trade the both. You see, the fact is that when we are waiting for this retracement to come down to your equilibrium, you can trade it. You can trade it because you already know and when you are trading it, you should look to take your profit at this equilibrium level and based on some POI, point of interest. You understand? You can trace the retracement back to this equilibrium level, but it all depends on how versatile you are with the market. You understand? I trade both ways. I'll buy, and then when the retracement comes, I'll what? I would still sell. Mr. Ayala, what's your question? You are raising your hand.
Yes, sir. Sorry for that, sir. At the retracement point, at the equilibrium point, you know, there are times it will give maybe a reversal pattern. That means it wants to go up, maybe like AMA, yeah, AMA. But at the end of the day, maybe if you enter the trade, it will start going down again. So, what are the confluences you need to consider at that
See,
equilibrium
when it
point?
comes to market structure, but like I said, market structure is really the basic of everything. You see, the reversal pattern you're talking about now, each market, we have two types of reversal pattern, type 1, type 2, and then type 1 is subdivided into two parts again. So by the time you are waiting for your break in market structure, you understand, right? Or your retracement to go back, there must be one out of the four market, the reversal pattern that you find there. There will be one out of the reversal pattern that you find there. So let's move to the chart. Let me share my screen, then we'll go to the chart. We'll see a practical example of it. Anyway, so we are running out of time. Okay, we're having less than 10 minutes. I hope you can see my screen.
Yeah, we
Yes,
can see your screen.
The chart, right? Okay, so like I said, so you go to your higher time frame, mostly your 4 hours time frame or your what, or your daily time frame, depending on the kind of trader that you want. Better still, for the fact that I'm using synthetic indices, it doesn't mean it's not applicable to currency pair or cryptocurrency. It's applicable to it's all the same thing all over. You understand? It's all the same thing all over. The same concept everywhere. The same concept that is applicable on synthetic indices is also applicable to what? To currency pair or cryptocurrency or any asset that you can think of. Or Google, you like open Google asset, MTN share, just open any chart. So far it has an open and a what and an eye. You can always trade it. So can everybody just make a mention of choose any trade, any pair that I want us to work with that I'll use as a practical example. Anybody should suggest any pair we should work with?
this 75.
Use step index.
Sir?
Step index.
Step index. Okay. So one thing is that if you actually want to use this thing, but when it comes to trading, I would always advise you just to pick 2 or 3 pairs. Don't trade everything. We have more than 15 assets in synthetic indices with tariff. Doesn't mean you have to trade everything. If you say you want to trade everything, you will not be profitable. Just pick 2 or 3 pairs and then you master this. You understand? So you go to a higher time frame. Right? You go to a higher time frame. Okay. So you go to your higher time frame, mostly your what? Your 4 hours time frame. Right? Remember what I said earlier about. So for step index now, there's another thing I forgot to mention. You see, okay. Now the last swing, right, on this 4 hours time frame now is going to be this. Right, this is the last swing. Right? Let me make it green so that we know that's our eye. And let me make it more bolder. So you know that this is going to be our eye. Then you mark out the low. This is going to be the low, the lowest part of it. Right? That's the lowest part of it. Okay. Let's use red. Now we know that okay, green for buy and sell. So this is the what? This is the range now. This is the range, right? So on our 4 hours time frame, now we want to catch out whether it's going to be a buy or a sell. So you move down to your what? To a lower time frame, and then you look at the previous swing. Actually, this is another swing. This is another swing here, right? This is another higher, lower high here. I can consider this to be our lower high here, right? But the larger one, this is going to be for our dot. This range is equally the same range with our what? With our daily time frame. By the time you go to your daily time frame, you see that it's still going to conform with your daily time frame structure. You can see what I'm saying, but it's still going to be the same range on your what? On your daily time frame. So that's why sometimes when you mark out your range on 4 hours time frame, most times it's still going to be applicable on your daily time frame, right? So this was our last swing on our daily time frame and also our 4 hours time frame. So if you are looking at your time frame combination now, let me go to your time frame combination. So basically, I tell you, you can choose three time frame you work with. One higher time frame, one medium that will be in between the higher time frame, and then one lower time frame. The lower time frame, you use it for your entry most times. And then basically for my students, I have a template of time frame I gave them to work with. Right.
You're not doing now.
You said?
Let me see.
What do you say?
Online. Yeah.
Okay, so for the time frame bar, we have this time frame confluence.
Inshallah, please mute your mic. Mute your mic. You're disturbing us.
So for the time frame combination bar, let me share another screen to show it. I hope you can see my screen.
Yes.
I hope everyone can see my screen.
Yes.
So for the time frame combination, right? Like I said, you have to choose 3 time frame, one higher time frame, one middle time frame, and then one lower time frame. So basically, your lower time frame is what you use for your entry. Then your higher time frame, you use it to confirm your trend, right? Then the next time frame that is a little bit lower to your higher time frame, you use it to confirm your short time trend. Understand? The higher time frame will always be for a long time trend. While the next lower time frame will be for what? For your short time trend, and then your lowest time frame will be for your entry. Right. So mostly as the kind of trader that we are, that every trader we are, we always try to be in between. Either you are a scalper or you are a position trader, intraday trader. So mostly all 85% of traders that we have currently now are going to be either you are an intraday trader or a scalper. We have very few people that are swing trader or position traders. So for that reason, I always advise you work with your higher time frame should be your 4 hours time frame or your daily time frame, right? Then either of the two, you can use any of the two, but conveniently, I choose to use this third one, your 50. So your lowest time frame is going to be your 15-minute chart, while your next higher time frame is going to be your 1 hour time frame, and then your 4 hours time. So your 4 hours time frame, you use it to confirm your long time trend. While your 1 hour time frame, use it to confirm your short time frame. Then on your 15-minute time frame, you can now look for intraday trend. You understand? And then from that same 15 minutes now, you can also take your entry from it. Like, so you can take your entry from it. So let's go back to that. So our time frame that we are using is our 4 hours time frame, right? So mark out our range there, market structure there, which is this. So we mark out our range on this now, right? So the next thing we need to do is to go back to our to next lower time frame, guys. The next lower time frame is following the higher time, which is our 1 hour time frame, right? So we mark out our range on range like this. So we go to our 1 hour time frame, and then we'll check the short time trend, the short time market structure on our 1 hour time frame. So on our 1 hour time frame, this was the range that we have, right? So like I said, for the BMS, for the reversal pattern, we have two types, type 1 and type 2, right? I'll just run through it. So for the type 1 reversal pattern, right, we have it like this. If the market is coming from an uptrend like this, we have higher high, higher low, higher high. There will be a BMS. This is the BMS, right? Then we'll now have another BMS to take out this low here. Then you can now have your retracement back. This is type 1 reversal pattern. Like this is type 1 reversal pattern. You can call it your normal M, your advanced M, as the case may be. And then for the type 2 now, you have it to be like this. Higher high, pay to make a new high, and then you have it like this. So this is type 2 reversal pattern. And these are type 1 reversal pattern. So the